Greetings, critical learners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. Today we continue with our Paper 1 revision as we prepare for the prelim paper. Here are my objectives for today's lesson. I am going to look at the structure of Paper 1, and I'm going to also look at the cash flow statement calculations. I will look at financial indicators, and today we're going to interpret some financial information. It is of great importance, dear learners, that as we follow today's class, you must be able to write somewhere. So you need to have a pen, a paper, and the calculator is of great importance. Remember, you need to keep a calculator that you know, a calculator that you are used to, such that on the day of the exam, you don't take a calculator that you are not used to. When we talk of the structure of Paper 1, it is of great importance that you understand that there are questions that are likely to come in your exam paper. As you see here, the first part that I have is the calculation of correct net profit after tax and the statement of financial position. So you will find that on question 1, this first question here, the examiner can have 4 options that the examiner can exploit in testing this particular question. And I'll show you all the 4 options that the examiner can use to test this particular question. But then on question number 2, you would find that you would normally find your cash flow statement and financial indicators. And we're going to do that today. We're going to do some calculations that relate to the cash flow statement as well as financial indicators. Analysis and interpretation of financial statements is also of great importance. And in today's class, we're going to do analysis as well. Auditing and corporate governance, I want to encourage you to study on this area because in the exam, we are likely to find questions that relate to auditing and corporate governance. The second option that the examiner can exploit, remember I spoke about the 4 options that the examiner has that they can exploit in testing question number 1. The first question that I just spoke about, it was the calculation of correct net profit and then the preparation of the statement of financial position, whereby the examiner can exploit either the assets part or the equity and liabilities or the entire statement of financial position, depending on the demands of the examination. But the second option that can be exploited, you will see that it is the statement of comprehensive income and the statement of financial position. So here now, we are not having the calculation of correct net profit. It is the statement of comprehensive income as well as the statement of financial position. You will realize that your other questions remain the same. That is your cash flow, your analysis, and auditing together with corporate governance. Those will then remain the same. So the one option that can be changed is that question number 1. All right. So this is the second option that the examiner can exploit, the statement of comprehensive income and the statement of financial position. Remember, in the first option, we have the calculation of correct net profit together with the statement of financial position. The third option that can be available is the statement of financial position and notes. So the examiner can exploit this option now, which becomes the third option, where you can be asked to prepare the statement of financial position together with some notes. Again, you will see that these options remain constant. They are not changing, but question 1 is the one that can be exploited. And then the fourth one is the statement of comprehensive income and notes. So this is a full statement of comprehensive income and notes. All right. And again, you see that the rest remain the same. I want to encourage you to prepare adequately as you will be writing the exam paper. Please, let's prepare adequately. In today's class, as I've already promised, I'm going to look at the cash flow statement, and then we are going to look at the analysis and interpretation of financial statements, and then we're going to do some interesting questions. Please do stay tuned to today's class. And to begin with, we're going to do activity 1, which is extracted from the NSC June 2023 paper 1. And to begin with, we're going to do question number 2. Let's see the demands of this particular question. I want to encourage you that if you have this question paper, have it next to you such that when I explain some of the things, you can look at the question paper in front of you and see the calculations that I'm doing so that this lesson can be of benefit to you. All right. But most importantly, you have to write the things that I'll be giving you, the calculations that I'll be doing with you. Make sure that you take them down as you will benefit from them. All right. So what we're given here is an extract statement of comprehensive income on the 20th of February, 2023. And the information that we are given, we have our sales, depreciation, interest on loan, then the net profit after tax. It is very, very important that you see here that you are given net profit after tax, and you are given the tax rate of 30% on net profit. That simply means what you are given there is not the 100%, neither is it the 30%. That means you have to understand very important principles, that you have what is known as your net profit. I'm just going to write before tax, net profit before tax, and this is 100%. Your net profit before tax is 100%. And then in this particular question, we are given income tax, and we are told that the income tax is 30%. Income tax is 30%. You can see I'm subtracting it so that I end up now with net profit after tax, which is 70%. The net profit after tax becomes 70%. So what we're given here is net profit after tax. So this amount that we have here is then equal to 70%. Very important. As we go on in today's class, when we are doing some particular calculations, we will be referring back to this key aspect. It is of great importance that you remember what I have just done. Okay, let's continue and see the next information. The next information that then follows says interest on loan. All right, so remember we are preparing the cash flow statement, and what we have is interest on loan. And since we are given interest on loan, remember we are preparing the cash flow statement. And you have to know your cash flow statement that it is split into 3 parts. You have your operating activities, you have your investing activities, as well as your financing activities, your O, your I, and the F. And remember to practice on the cash and cash equivalents part, the net change in cash and cash equivalents part. Remember to practice on that aspect. And then the first information that we would think of when we are doing the cash effects from operating activities is the cash generated from operations. In this case, this figure was provided in the answer book, so it was not a problem at all for us. What we were supposed to do is to complete this part. And I know that my cash effects from operating activities, I will record 4 things that will go into the cash effects of operating activities. I am going to record, I'm just going to list them down. All right. I'm going to record first my interest paid. And already the moment I say paid, you have to remember there has to be a bracket, cash outflow. And then I'm going to record my taxation paid. So the moment you say paid, remember it's a cash flow statement. It will be an outflow. And the last one, the third one that I will record is my dividends paid. And my dividends paid is also an outflow. That therefore means that when I'm doing my cash effects from operating activities, I have 4 aspects. All right, I have my cash generated from operations, which is number 1. Number 2, I have my interest paid. Number 3, I have my taxation paid, and I have my dividends paid. Of these 4 things, 3 of them will always be outflows. Interest paid, taxation paid, and dividends paid will always be in brackets. That simply means even before I write anything here, I have to know at the back of my mind that it's going to be a cash outflow. Of the four things that come under operating activities, you have your cash generated from operations, then you have your interest paid, cash outflow, you have your dividends paid, cash outflow, and you have your taxation paid, cash outflow. So let's begin first. Then I'll write my interest paid. You can see that in the statement of comprehensive income, it's recorded as interest on loan. But when I come here, it becomes interest paid. So I'm going to come and say interest paid. So I have my interest paid, and I'm going to put it in brackets. And my interest paid is then going to be 648. Remember, I am given that amount here. So I'm going to come here and I'm going to have my 648,000. That is my interest paid. All right. So my interest paid becomes 648. And remember, paid, cash outflow. Therefore, remember to put brackets. Brackets are of great importance. You need to put in your brackets. All right, so there it is. We have done that part. So I'm going to move on to the next aspect. The next aspect that is required of me is to record. Remember, I spoke about four things: cash generated from operations, interest paid. Then I'm going to go now to the third one rather. That is your taxation paid, or your income tax paid. So I'm going to do now the income tax paid. With the income tax paid, I have to do some calculations first. All right. So one of the easiest way to do these calculations is to open what is known as a T account. So I'm just going to open a ledger account here, and I'm going to open it right here at the corner. I'm going to open a ledger account. All right. And then this is my tax account, and I'm just going to come here and say this is my tax account. I know there are several ways of doing this. I'm just going to exploit two ways today: the ledger account, and I'll also show you the other method. So with the tax account, you now have to know your balances. You are given the balance in 2022 and another balance in 2023. The balance in 2022 is a credit balance of 42,100. All right. So I'm going to come to my ledger account. I know this is my debit and this is my credit. So I'm going to have here my balance. I'm just going to say balance BD, and then I have my 42,100. That is my balance on the income tax. And then I know that I'm going to have a closing balance. So here's my ledger account. Remember that. And then my closing balance is a debit balance here. That means I'm bringing it here as my balance brought down 23,600, because this is a debit balance. And that debit balance, when I come here, it's going to be balance carried down on the credit side now. So I'm going to have my 23,600 here. The last thing that I then need is my income tax. I now need to know how much is income tax, which I'm going to record here. Here, I'm going to have my income tax. I am told here that net profit after tax, remember I spoke about that earlier on. That means this amount is equal to 70%. You're correct. Now, what is it that we want? We want the income tax, which is 30%. So I'm going to come here then, and we're going to say what I want is 30. What I have is 70 multiplied by 1,526,000. And when I punch that in my calculator, I'm now going to have, remember, I'm saying 30 over 70 multiplied by 1,526,000, and then I'm going to have 654,000. The 654,000 therefore becomes my income tax. So I'm going to come here and I'm going to end up with 654,000. My income tax is 654,000. Now, I'm going to get the total here then. And for the total, I'm now going to say 42.1 plus 654 and then the 23.6. When I add this together, I'm going to get 719,700. All right, then I'm going to get 719,700. Here I'm going to get 719,700. Therefore, I'll come here. This is what we have paid. Bang. For income tax, 719,700. That becomes my tax paid. All right. Then what I know is I have to record that now in the cash flow statement. But here is the calculation that I done earlier on, and here is also another one, which was the calculation, which still gives me the 719,700. How do I then record that? It comes under my cash effects from operating activities. So I'm going to come in and say tax paid, and then you get your 719,700. Okay, so I'm going to move on now to the next calculation. The next calculation has to do with dividends, and it says on the information, we are given 1,250,000 shares at the beginning, and then there was 180,000 shares which were repurchased, and then we are told we issued shares here, and then we have that at the end of the year. But one of the most important things that we have to remember is when we are given the statement of financial position, we are given what is known as shareholders for dividends. So these are your final dividends. These are your final dividends. Remember, we have two types of dividends. We have the interim dividends, which are paid. Interim, paid. Then we have the final, declared, recommended. This is all one and the same thing. Final dividends are not paid, but they are declared. They'll only be paid in the next financial year. It therefore means when we're doing the cash flow statement and when we're calculating information that relates to dividends, one of the most common things is that we will pay last year's final dividends in this current year. So what we are certain of at the moment is when we are to get our dividends paid, we have last year's final dividends here, which is 475,000. So we're going to consider that already. But we will need to calculate what are known as interim dividends. To get the interim dividends, we will now say the number of shares that we were having at the beginning, which is 1,250,000. Then you have to remember that we have repurchased shares, which is 180,000. So when shares are repurchased, which is this 180,000, we subtract them. All right, these shares were repurchased. And then the statement goes on to say they do not qualify for dividends. So that simply means the 180,000 shares that we have bought back will not receive dividends. In that case, it simply means when we're giving interim dividends, we can't give to this 180,000 shares because they have been repurchased. So we must give it to the remaining shares after we have bought back the shares. So we'll now say 1,250,000 minus the 80,000. That leaves us now with 1,070,000. That 1,070,000 are now the number of shares that we can give dividends to. And we are told that an interim dividend is given at 32 cents per share. So I'll now say the 1,070,000 multiply by 32 cents. That then gives us 342,400. That becomes my interim dividends. Once I have my interim dividends, remember what I said when we calculate dividends paid. It becomes very easy. You simply say last year's final, here is last year's final, last year's final, the 475, which is this one here. All right, plus this year's interim, which is what we've calculated here, and then you have a 345,400. And remember, it is also a cash outflow. Remember, we spoke about the brackets. Very important, dear learners, that you remember this. You can do it this way. This year's interim plus last year's final. This is interim plus last year's final. These are the dividends that we have paid, and they will be shown as a cash outflow. Very important aspect, that when you're calculating dividends, remember to check the number of shares. Remember to check the number of shares. And dates are very important. Dates are very important because you have 1,250,000 on 1 March, that is the beginning. And then you repurchase shares in May. And you see that the interim dividend is given in August. So the interim dividend is only given after these shares have been repurchased. I'll repeat that again. The interim dividend is only being paid after these shares have been repurchased, because these shares are being repurchased on the 1st of May, yet the interim dividend is being paid on the 31st of August. So you have to say your 1,250,000 minus the shares repurchased to see how many shares are you having on the 31st of August when the interim dividend is being paid. And you can see in our calculation that we only had 1,070,000. So that is what you then use when you multiply by 32 cents, the number of shares that will be in issue. All right, follow the instructions of the examiner. I'll move on from now, and then we'll come now to the completed part of the cash effects from operating activities. One thing of great importance, as I said earlier on, these three are always in brackets. You can see interest paid, cash outflow, income tax paid, cash outflow, and dividends paid, cash outflow. These will be in brackets. And then the cash generated from operations, it was given in the answer book. And then you do your calculation, you end up with cash effects of operating activities of 155,200. Remember, dear learners, calculations must be shown in brackets, and then do not leave any blank spaces. I want to encourage you. We are not leaving any blank spaces this year. We're going to write as much as possible, but we're not writing anything. We're writing things that make sense. All right, thank you. Let's move on to the next aspect. And the next aspect now is the next part of this question, which is activity number 2. Activity number 2. And activity number 2 says, calculate the following financial indicators on 28 February 2023. So we are given some financial indicators that we must calculate. Dear learners, you will understand, and you have seen that the answer book, the question paper rather, at the back of the question paper, you have the formula sheet. However, I want to encourage you not to over-rely on the formula sheet. You need to know the formulas. You need to know the formulas. And then the formula sheet will only assist you. But you cannot go to the exam saying the formulas will be given, because I think you've seen by now that in the formula sheet, the name of the indicators are not given. So you need to know the indicators by heart. They need to be in your fingertips. And then when you look at the formula sheet, it just helps you to remember. But you can't over-rely on the formula sheet. Please do not over-rely on the formula sheet. The first question that we are supposed to answer, it says, calculate the following financial indicators on 28 February 2023, and then we're calculating the current ratio, the net asset value, the percentage return on total capital employed, that is your ROTCE. All right, let's see, we're going to do them one by one. The current ratio. As we do our current ratio, it is greatly important, dear learners, that you know the formulas, as I have said. All right, so on the current ratio, let's see if we're given any information. We are given total current assets and total current liabilities. Okay, but you have to know the formula. The formula for the current ratio, it is your current assets as to current liabilities. The formula for the current ratio is your current assets as to your current liabilities. So this must be known. This has to be known, that you're taking your current assets as to your current liabilities. Okay, let's begin to do that. So if I come here, I am now going to say, on my current assets, how much is my current assets? My current assets are 1,500,000. 479,600. That is my current assets for the year 2023. And my current liabilities are 822,000. So I'll come here and say 822,000. That is my current liabilities for the same year. This is a ratio. When it is a ratio, it means your answer has to be as to 1, as to 1. And in order for you to get an answer that is as to 1, you must divide everything by what is on the right side. And on the right side, you have 822,000 here. That gives you the 1 then. Are you following? All right. So you have your 822, you divide by the 822, that is what gives you the 1. And then you come here, you divide this again by the 822,000. And if you punch that in your calculator, you will get 1.8. So your answer then becomes 1.8 as to 1. As you see here, that is your 1.8 as to 1. That is your current ratio. In this question, the demands were calculate. So that is what we are doing. If we are going to analyze and comment, we'll do it later. But the demands at this particular point is calculate. And we have done exactly that. Let's go to the next one and see what else do they want us to do. In the next one, they say, calculate the following financial indicators. That is your net asset value, the NAV. The information that we are then given has to do with shares. We are given information that relates to the shares. Okay? And then we know that when we're calculating the NAV, the formula is going to be your shareholders' equity. So I'm going to say my shareholders' equity divided by the number of shares in issue. Multiply this by 100 cents. All right? So it is my shareholders' equity divided by the number of shares on hand or in issue on hand, and then multiply that by 100 cents. My shareholders' equity, I remember it's made up of 2 notes. You remember those notes? Note number 7 and note number 8. That simply means note number 7, I'll come here, this is my ordinary share capital. Okay, so I'm sorted there. And then I now need the information for note number 8, that is my retained income. The retained income was provided already in the in question 2.1, and it was 629,600. So we have the retained income that we're going to use, which is 629,600. So I'm just going to write it here, 629,600. There's a question that demanded this, and this was already calculated. Now, when we have this, then we can start punching in the figures. All right, so let's see how much is my shareholders' equity going to be then. Okay, I'm going to take my 13 million, which is this one, 959,500. Then I say plus the retained income, which is 629,600. Okay, so I've added this, and I then divide it by the number of shares on hand. The number of shares on hand. In this case, it is given already, which is your 1,370,000. 1,370,000 shares. Then I multiply this by 100 cents. I multiply it by 100 cents. Okay, and then I always like to add these up before I can divide, so that I can see exactly what I'm doing. So I'm going to say, take your calculator now and add 13,959,500 plus 629,600. How much do you get? You will get 14,589,100. Okay, so you have added these two. You have added this one, and then you are dividing it by 1,370,000, and you're multiplying it by 100 over 1. Okay, so once you have done that, then it becomes easy. I always want you guys to know what it is that you're adding. Add that first, then write it down in your answer book, and then you come and you also do that one, so that you don't make mistakes. All right, don't punch everything into the calculator. Remember, calculations must be shown in the answer book. In the answer book, calculations must be shown in the answer book. So as I had done already, there is my amounts, and then we'll end up with 1,064.9 cents. Remember, what are we calculating for? The net asset value. According to us as a company, how much is the value per share? And the value per share is 1,064.9 cents. That is the net asset value per share. All right, let's go and see if we can do another calculation again. The next calculation then, which is required, is calculate the percentage return on total capital employed. So we're talking about the ROTCE, the percentage return on total capital employed. All right. Now, it is very important that you know what is your total capital employed. Your ordinary share capital plus the retained income plus the long-term liabilities equals to your total capital employed. As I said earlier on, you need to know your formulas by heart before you go into the examination. So let us now come and do some calculations over here. What we know is that if I am to calculate my percentage return on total capital employed, I'm going to need my net profit before tax. All right, so let me just write the formula down. My formula is going to be my net profit before tax, and then I'm going to add my net profit after tax. Here I have net profit after tax. Remember, I need net profit before tax plus my interest, net profit before tax plus my interest, and I divide this by my average capital employed. I divide this by the average capital employed. Okay, and then I multiply this by 100/1. Very important. What are we given here? We are given the net profit after tax. But what do we want? We want net profit before tax. And remember, it is easy to calculate that because I know that my net profit after tax is 70%. So I can get my net profit before tax. That simply means what I want is 100 and what I have is 70. Multiply this. So 100 is net profit before tax. 100 is net profit before tax. 70 is net profit after tax, which is given here. So I'll say 100 over 70. Multiply that by 1,526,000. Okay. And then when I punch that into the calculator, I'm now going to get my 2,180,000. 2,180,000. That becomes my net profit before tax. So I'm going to come here at the bottom. I'm now going to say I have 2,180,000. Then I'm going to say plus my interest on loan, which is 648,000. Then I add my 648,000. And remember, I'm dividing all of this by my average capital employed, which is 20,343,500. Then I multiply this by 100/1. Okay, so after I've punched all of this in the calculator, then I should get my answer. Remember, I have my 2,180,000 plus the 648, and then I'll end up with 13.9. So my answer here becomes 13.9%. 13.9%. Very important that, as I said earlier on, you need to know your formulas. Let's go on to the next one, which is now activity number 3. Activity number 3. And activity number 3 reads, you are provided with information relating to Tumbu Limited for the year ended 28 February 2023. And then provide financial indicators with figures and trends to support your comments or explanations where applicable. Now, you have to understand the demands of the examiner. The question here says, provide financial indicators with figures and trends to support your comments or explanations. So what is very important is the financial indicator. We're talking about the name here. We're talking about the name of the financial indicator. You have to give a name. And then the figures, we need the percentages or the cents, we need all of that, the figures. And the trends, when we talk about trends, we're talking about either an increase or a decrease, or the amount has remained constant. All right, so we need to know the trend. What is happening? Is it increased? Is it decreased? Or is it remained constant? All that is very important as we will be doing this question. Now, question 3.1 then says, explain whether the company is managing their working capital efficiently. Quote 2 financial indicators. So you have to know the working capital financial indicators that are required in this particular question. But one of the easiest ways to understand is here we're dealing with what? Liquidity. All right. So we are talking about working capital. All right. And then this particular question is referring to liquidity. So this therefore becomes very easy for us. And let's see what more information we are given. In the information that we are given, number one, we are given information on the current ratio. So we have the current ratio, and then we have the asset test ratio, and then we have the average debtors collection period. Let's begin with the first one, with the current ratio. You can see that the current ratio has decreased. Remember that when you're commenting, you're coming from 2022 going to 2023. So in 2022, but the first thing that I've done, I bring in the name, current ratio, because the question wants me to talk about the name and the figures as well as the trend. So I'm going to say the current ratio, that is the name, has decreased. Where do I see the decrease? It was 1.3:1. Now it's 0.9:1. So that shows a decrease. The current ratio has decreased from 1.3:1 to 0.9:1. So that is very important. I have the name, the trend, and the figures. It is the name, the trend, and the figures. Very, very important. So we have number one, which is your current ratio. And here we were required to quote 2 financial indicators. So the first one, we have the current ratio. The second one, we're going to look at the acid test ratio. Remember the difference between the current ratio and the acid test ratio. With the acid test ratio, when we're calculating it, we exclude inventory. So it is your current assets minus inventory as to your current liabilities. So when we come to the acid test ratio, you can see it was 0.6:1 in 2022. In 2023, it's now 0.3:1. Again, you can see it has decreased. So I start with the name. The acid test ratio has decreased from 0.6:1 to 0.3:1, a decrease. Then the last one is the average debtors collection period. This simply tells us of the average number of days that debtors are taking to settle their account. In 2022, it was 30.8 days, which was good. In 2023, it is now 42.4 days, which is now more. What that means is debtors are now taking more time to settle their accounts. That affects our liquidity because now debtors are taking more days for them to settle their accounts. So you see here, we say the debtors average collection period has increased from 30.8 to 42.4 days. That is not a good situation. When your debtors collection period increases, it simply means cash is now only going to be received after a long period, in this case, after 42.4 days. So it does affect the liquidity of the business. We can therefore comment and say, the business will experience difficulty in meeting short-term debts. Short-term debts. Remember, we are talking about liquidity. All right? We're talking about liquidity. So when we look at these financial indicators, we can see that the business will have difficulty in meeting its short-term debts. they will not be able to pay their short-term debts because the current ratio has decreased. Number two, the asset test ratio has decreased and the average debtors collection period has increased. Debtors are now taking longer. So you can see here on the second point that debtors are now taking too long to settle accounts, and therefore we can see that the business will have difficulty in paying its short-term debts. All right, that is question number 3. Okay, let's continue. In the next question, it then is talking about major shareholding. Or shareholding. The question reads, Denise Taylor, the CEO, owned 540,000 shares. So Denise owned 540,000 shares in the company on the 1st of March 2022. So the 1st of March is the beginning of the financial year. This is the beginning. And she is owning 540,000 shares right at the beginning of the financial year. She continued to buy additional shares on JSE at various times during the year. So she is buying shares at various times. On 28 February 2023, this is now the end. This is now the end. Remember, the beginning, and this is now the end. Here it's the end. Denise became the majority shareholder as she then owned 51% of the shares in issue. Remember, when we calculate major shareholding, we have two options. Number one, it is your 51%. If a person holds 51%, then they become the major shareholder. The second option is when they have 50% plus 1 share. All right, then they are also major shareholders. In this case, the question is directing us towards using 51%. So we're going to use the 51%. That she owned 51% of the shares in issue. Now, the demands of the question are calculate the total number of additional shares that Denise has purchased. How many more shares has Denise purchased? Let's go and see if we're given more information. On 1 March, the company issued additional 300,000 shares. 1 March, remember, this is the beginning. On 28 February, there were 1.5 million shares in issue. 28 February, remember, this is the end. So on the last day of the financial year, the company has 1.5 million shares in issue. So that simply means if the company has 1.5 million shares in issue, and this particular person, Dennis, owns 51% of these shares, we therefore come and we say, of this 1.5 million shares, 1.5 million, Dennis is having 51%. So we're going to get 51% of that. Let's quickly punch our calculators. Let's have them ready. We're saying 1.5, multiply that by 51%. That is going to give us 765,000 shares. That simply means on the 28th of February, on the last day, Denise is holding 765,000 shares. All right. Now, if Denise is now holding 765, but at the beginning she had 540, she had 540 at the beginning. She had 540 at the beginning of the financial year. At the end of the financial year, she has 765. The question is, how many shares did she buy? This is an easy one. So we can simply get this one, I think so. Remember what we said, 765, we've calculated that. So we are now saying if she has 765, now 765, and then at the beginning she had 540, how many more shares did she buy? She bought 225,000 shares. That answers this particular question. How many shares did Denise buy? She purchased 225,000 shares. Very important, dear learners, that you remember that when you're calculating major shareholding, you have the option to use 51% or 50 plus 1 share. But it is very important that you know how to do these calculations. In this particular question, they told us that she owned 51%. 25% of the shares in issue. Let's move on to the next one. Okay. The next question then says, give one possible reason why Dennis was determined to become the majority shareholder. Why would Dennis want to become the major shareholder? We want to know why. In other words, we want to look at the advantages. What are the benefits? What do you possess when we say you are a major shareholder? What are the advantages of being a major shareholder? Why did she want to become a major shareholder? Point number one, she wants to have full control of the company. The moment you are the majority shareholder, you can have control of the company. The next one, she wants to influence. This is very important. She wants to influence all decisions of the company in the future. When you're a majority shareholder, you have the ability to influence decision making. So she wants to influence all decisions of the company in the future. She wants to address the issue of incompetent directors, influence new appointments who can contribute to the growth of the company. So if a company is having incompetent directors, as a majority shareholder, you can then be able to influence the new appointments of directors who can then have a positive contribution to the company. This, therefore, is the third reason why she wants to become a majority shareholder. Point number four, she feels she can kickstart a turnaround of the current situation. Remember, when you look at this company was having financial challenges. Remember, in the previous question that we did, they were not able to meet their short-term obligations. So this company is having financial challenges, and she is now owning 51% because she feels that she can bring a turnaround to the current situation. All right. So very important, dear learners, that you understand what it means to be a majority shareholder. Okay. I'm going to move on to the next question. And the next question has to do with decisions by directors. It says, identify two major decisions taken by the directors in 2023 that were different to those from the previous year. Give one reason for your decision. So we are comparing decisions made in 2023 to those of the previous year, 2022. Okay, let's go and look at those decisions. So here is the cash flow statement. Here's the cash flow statement for the year 2022 and the year 2023. And we want to look at major decisions. When we look at major decisions, we have to consider a number of things. We have to consider the size of the amount. We have to consider the size of the amount. It is of great importance that when we look at major decisions, we look at the amounts that were involved in particular decisions. All right. So let us begin with the first part. The first part, we're going to look at our cash flow from financing activities. Cash flow from financing activities. You have to understand that when you get to the cash flow from financing activities, you will get mainly two things. Number one, it's going to be your shares and it's going to be your loans. All right. So when we look at the cash flow from financing activities, our finance for a company is either through own finance, own capital, own equity, shares, or borrowed equity, loans. So two sources of finance. As you see here, you have shares and you also have loans. Now, if we look at it, you can see that in the year 2022, we have repurchased shares. You can see that we have repurchased shares. That's why you see you have a bracket or a negative 250,000. That's a cash outflow. That's a cash outflow. Remember, we're in the cash flow statement. So in 2022, we have a cash outflow. That means we have repurchased shares. But in 2023, you can see that now we have an inflow of 3,750,000. That simply means we have now issued shares. Here we have issued shares over here. We have issued shares. So let us therefore see if we can talk about that. That in 2023, the company issued more shares. So in 2023, we issued more shares and we received 3,750,000 rands because we've issued shares in 2023. Whereas in 2022, the company bought back shares and they paid 250,000. That is one major decision. You can see the amounts that we're dealing with. Here we're dealing with 3,750,000. That's a major decision by the directors. So one major decision is that the company has issued more shares as compared to the previous year when the company bought back shares. And then it then says, give one reason for this decision. What could be the reason for such a decision? You have to understand that the moment we issue more shares, it brings about stability in terms of the company using its own equity. So there's an attempt rather to sustain the company by using own capital. Remember, I said two forms of equity, two forms of finance. Either own equity by issuing shares or borrowed equity through loans. There is a disadvantage with loans and there is an advantage with having own finance. And here there's an attempt to sustain the company by using own equity. All right, we're going to look at that as we continue in today's class. But one major decision, we look at the size of the amount. Remember, here they've spent 3,750,000. That was one major decision. Let's go and look at the next one. The next major decision, we're coming now to the loans. You can see that in 2022, we have 3.5 million on the loans. And no bracket here, that simply means it's an inflow. And once we have an inflow on the loans, that means we have received a loan. We have received a loan. But when we come here, it's 1.8. That means this is a payment. It's a cash outflow. We have repaid the loan. So we can see here that the directors have made a decision that in 2023, they have repaid 1,800,000 of the loan. They have repaid 1,800,000 of the loan. Whereas in 2022, they borrowed 3.5 million. Okay, so in 2022, they borrowed 3.5 million, and then in 2023, they have repaid 1.8 million of that loan. Now, the next question then says, what could be the reason for such a decision? What could be the reason for such a decision? The company wants to place less reliance on loans. Remember, the more loans we have, remember, loans are affecting us. Remember, when we talk about the debt equity in terms of risk and gearing. So the moment we have more loans, there is more risk. And then you can see that here the company is trying to pay back the loans. That is, they want to place less reliance on the loans. They don't want to rely more on the loans. Hence, they are paying back the loans. And you have to understand that the moment the company has more loans, it also means they will pay more amounts in terms of interest. So by trying to avoid the large payments on interest, the directors have decided to pay back 1.8 million towards the loan. All right, so these are two major decisions that we see that were taken by the directors. Let's move on to the next question. It says, explain the impact of these decisions on the degree of risk, or financial risk over the 2 years. Quote one financial indicator. All right, so we want to explain the impact of these decisions. Okay, let's see what information we are provided with. We are given the debt equity ratio, which is 0.4:1 in 2022. And then in 2023, it is 0.1:1. You will see that two things were done here. Two things were done. Number one, the company issued shares. The company issued shares. When the company issued shares, it increased equity. It increased equity. And the company repaid loans. The company repaid loans. When they repaid loans, it decreased the debt. It decreased the debt. So when we come to the debt equity ratio, remember the formula for the debt equity ratio. It is your non-current liabilities as to shareholders' equity. Now, what is happening, what the company did is they repaid the loan, they decreased that, and they issued shares, they increased that. That is why you find from 2022, it was 0.4:1. Now it's 0.1:1. Why? Because when shares are issued, it increases the shareholders' equity. And when we repay the loan, it decreases the non-current liability, thereby decreasing the debt equity ratio. As you will see here, that the debt equity ratio has dropped from 0.4:1 to 0.1:1. It has dropped. Why did it drop? Because the company has issued shares and it has repaid the loan. That is the main reason. All right. And then you can see that there's a reduction on financial risk, which has seen an improvement in share capital. So there's a reduction on financial risk as the debt equity ratio has decreased. The question was, explain the impact of the decisions made by the directors. And then we were to look at one financial indicator, which looks at the degree of risk. And we are looking at the debt equity ratio. As you can see here, there is a decrease from 2022 to 2023. Why is there a decrease? Because we issued more shares and we repaid the loan. Okay, I'm going to move on to the next question. And the next question reads, explain how these decisions affected the gearing of the company. Okay, so we're now moving on to the gearing of the company. You will see that when you talk about the gearing of the company, we want to see in relation to borrowed finance and the cost of maintaining that borrowed finance. Are we positively geared or negatively geared? And then it will assist us to see what is the better decision to make. In this case, the question says, explain how these decisions affected the gearing of the company. And then we're to quote one figure, one financial indicator. So we're going to look at the percentage return on average capital employed. The percentage return on average capital employed. You will see that your ROTE has dropped from 11.4 in 2022 to 9% in 2023. It has dropped, all right? And it has dropped mainly because we have repaid the loans as well, okay? So your ROTE has dropped from 11.4 to 9%. And you will see that the ROTE is below the interest rate of 13%. The interest rate here on loans is 13%. And your ROTE is below. That simply means the company is negatively geared. Okay, let me explain this part of the negatively geared. You will see that in 2022, the company had a percentage return. This is the percentage return of 11.4%. Let me explain this in simple terms. For every 100 rands that the company borrowed as a loan, they invested that money. And from every 100 rands that the company had invested, it was getting 11 rand 40. All right? So I'll repeat it again. From every 100 rands that the company borrowed as a loan from the bank, it invested that 100 rands. And the return on that 100 rand was 11 rand 40, which is what we have here. But you have to understand that when we borrow money, we have to pay interest. So the interest that we're paying on every 100 rands was 13 rands. It therefore means from what we were making from the 100 rands that we borrowed from the bank and invested it. It gave us 11 Rand 40. That 11 Rand 40 was not even enough to pay for the interest on the loan that we had borrowed. Therefore, you will see that here when you come, you're going to have a negative 1.6. That simply means, therefore, we are negatively geared in 2022. And then, if you come to 2023, you will see the same again. We borrowed money, and in 2023, for every 100 rands that we borrowed, it was now giving us 9 rands. But the interest for every 100 rands that we borrowed is still 13 rands. That simply means we are now further negatively geared by 4 rand. So you will see that the return on total capital employed is below the interest rate of 13%. Therefore, we are negatively geared in both 2022 and it has further dropped in 2023, as you see there. That is not a good position. The company was not making effective use of loans in 2022, and this trend has continued in 2023, in spite of the effects of attempts to reduce the loans. We have tried to reduce the loans, but however, this has not made much effect as the company is not making much use of these loans. As you can see, we are negatively geared. All right, so this is how we would then comment on the gearing of the company. And we had to quote one financial indicator, that is your ROTCE. But remember, for you to explain the positive or negative gearing, you also need to include your interest on loans. Okay, I'm gonna move on to the next question. And the next question has to do with dividends and earnings. It says, certain shareholders express concern about the change in the dividend payout policy. Explain 2 points to support their opinion. Okay, and then you can see that in 2022, the dividend payout rate was 67.6%. Remember, for you to calculate the dividend payout rate, you have to have your earnings per share as well as your dividends per share. So you are now saying what percentage of earnings is being given as dividends. All right. So here they've already calculated for us the dividend payout rate. All right. And they are now saying the dividend payout rate in 2022 was 67.6%. When you see such a percent, it means whatever was left out was retained. But if you look in 2023, they are giving 106.7% of earnings as dividends. 106% of earnings as dividends. Okay, let's now see, because they're saying certain shareholders express concern. Now, let us see why they would be concerned. The increase in the dividend payout rate to 106% from the 67 means that the funds that must be used, or the funds that must be used from retained income, now have been used rather to pay higher dividends, whilst earnings were low. Okay, let me explain this point. We pay dividends from our earnings. In this year, we have paid more dividends than earnings. It means we have taken part of what was retained. Okay, so we have taken part of what was retained so that we can pay more dividends, therefore, than what was actually earned in this year. This is what this point means. Once you see your dividend payout rate going beyond 100, it simply means now you are taking from your retained earnings. The next point is, the directors want to distract shareholders by trying to appease them. To appease them simply means to make the shareholders happy. All right, to make the shareholders happy in order to distract them from the poor performance of the company. Remember, the company is performing poorly. So in order to make the shareholders happy, he decided, or the directors decided, that they give a higher dividend payout rate such that they can make them happy. Directors are acting irresponsibly by showing no intentions for the growth of the company. Remember, Once you look at 2022, the directors had 100% of earnings to give as dividends, but they gave 67. That means they retained 32.4% was retained. To retain is to keep, remember that. So they retained 32.4% in 2022. But when they came to 2023, they did not keep anything. Rather, they took from what was retained to give. So once we keep or once we retain, that is where we can get funds for expansion, for growth. In this case, the directors are going to take from the resources that must be used for expansion or for growth, and they are giving them to the shareholders. That simply means the directors are not responsible. They're not acting responsibly enough, as they have no intentions for growth of the company. Let me go to the last point. The directors should have focused on improving the cash resources because they're actually depleting cash resources. Remember, we looked at the liquidity position of this company and we realized that this company was having cash flow problems, meeting its short-term obligations. And these directors are now going and taking of the resources that still remain and they're giving them to shareholders instead of trying to improve these cash resources. So you can see why certain shareholders have expressed concern, because the company is not performing well and the directors have decided to give more dividends. More dividends. All right, let's go on now to the next question. All right, the next question, it says, Activity 3, again, return and earnings. Explain whether shareholders should be satisfied with the trend in the percentage return and earnings. Okay, should be satisfied with the trend in the percentage return and earnings of the company, as well as the dividends they earned. Quote two financial indicators. All right, so we are going to explain that aspect now. What are we given? We are given the percentage return, the earnings per share, dividends per share, and the interest on fixed deposit. Let's start with the first one. When we look at the return on shareholders' equity, remember here, we want to explain whether shareholders should be satisfied with the percentage, with the trend in the percentage return and earnings. So the first one that we're going to look at is the return on shareholders' equity. You can see that it has decreased from 7.2 to 5.7. So your share has decreased from 7.2 to 5.7. It is now below the interest rate of fixed deposit, that is alternative investments. For a shareholder, if they are to invest in a company, the company that is being invested has to be better than the alternative investment. And in this particular question paper, the alternative investment that was given is the fixed deposit. So the interest on a fixed deposit is 7%, as you can see here. But for a shareholder who would have put his money in this company buying shares, in 2022, they were getting 7.2% return. In 2023, they're getting 5.7%, which is now below alternative investments. So once you look at your share, you have to compare it against alternative investments. Where else would the shareholder have put their money? In the fixed deposit. So you can see that the share has decreased from 7.2 in 2022 to 5.7 in 2023. In 2023, it is now below the alternative investments, which is giving 7%. Let's go to the EPS. Your EPS has decreased from 74 cents, all right, to 60 cents. So it has decreased from 74 cents to 60 cents. You can see that there is a drop there. And there is a drop in profitability by 18.9%. To get that 18.9%, you can simply say your 74 minus your 60. That's going to give you 14. Then you divide 14 by the 74. You multiply that by 100. It should give you the 18.9%. So there's a drop of 18.9%. And then the last point would be that the dividends per share has increased. You can see now your DPS has increased from 50 to 64 cents. Some may be satisfied with the 14-cent increase. Remember, they've given more dividends in this year. So some shareholders may be satisfied with this 14-cent increase, but others may be concerned as the company is paying high dividends, whereas its earnings have dropped. You can see its earnings have dropped from 74 to 60, yet their dividends have increased from 50 to 64. Remember, we addressed this aspect. They are taking from their retained earnings. So here we are explaining whether shareholders would be satisfied with the trend. And we explained, first one is the ROSHER, and we compare it with alternative investments. Number two, it is your EPS, and we're also looking at its decrease. And this is number two. And then number three, we are looking at the DPS, and we're also seeing what is happening. As you can see, the DPS has increased. Some may be happy, some may not be happy. Why? Because they're giving more dividends instead of retaining. All right. And then let's quickly now go on to the next question. It reads, some shareholders are angry about the trends of the following two issues relating to the performance of the company. So some shareholders are angry. Okay, we're being told that. And then we are to comment on cash and cash equivalents at the end of the year. So we're given 2022, and then here we have 2023. Let's go and see what we would therefore say. In terms of our cash and cash equivalents, you can see that your cash and cash equivalents has decreased by 836,000. All right, there's your 836. Compared to an increase of 2.2 million in the previous year. In the previous year, there was a 2.2 million. So some shareholders are angry about the trends in the cash and cash equivalents. Okay, why should they be concerned? Now, you have to understand that this information is coming from the cash flow statement. And if you look here, you can see that your operating activities here, you have a deficit. That simply means, therefore, that we are not able to generate income or cash from our operating activities. There is ineffective use of the funds. We can't use the funds in terms of operations. Hence, we end up with a negative on our operating activities. This has hugely affected the business such that we end up with a negative cash balance of 836,000. All right. And therefore, it is very important that when you're commenting on this, you come again to the cash flow statement. In this case, they wanted us to look at the cash and the cash equivalents. You can see it has decreased. Last year, we had 2.2 million, but this year we have a negative 836,000. I'll move on quickly to the next area of concern. It is the market price of the shares on the JSE. Whenever shareholders have a concern about the market price of shares on the JSE, it is of great importance that you also bring the NAV, the net asset value per share. Okay, so the JSE, this is what our shares are selling. This is what our shares are currently selling at on the stock market. But the NAV, this is what our shares are worth. You can see that in the year 2022, our shares were selling at 1,020 cents, yet the NAV is 980. This is a good situation. When your market price is above the NAV, that is a good situation. But if you come to 2023, you can see that the market price has dropped and the net asset value is 1,007 cents. So the market price has dropped. So we can say the market price on the stock exchange has decreased from 1,020 cents to 850 cents, which is what you see there. The market price of 850 cents is less than the NAV. Once the market price is less than the NAV, it will anger shareholders as their shares now are worth less on the market than what they are actually worth in the company. In other words, new shareholders can actually buy these shares at a lower price than what they are worth in the company. So the shares are not in demand by the public due to general decline in the company's performance. Once a company is not performing, people will not buy shares in that particular company. And when they don't buy shares in that particular company, the demand drops down. And then once demand goes down, then the market price is also going to decrease. As you can see, in 2022, it was 1,020, but in 2023, it's only 850 cents. So there was a decline in the price per share. Dear learners, we're going to take a quick 5-minute break, and I'm going to see you shortly in 5 minutes. After 5 minutes, we are going to do an activity from the NSC June 2022, and I'm going to focus on question 2. See you after 5 minutes. Welcome back, dear learners. Before the ad break, I promised you that I was going to do a question from the NSC June 2022 paper, question 2. All right, let's look at this question. It says, calculate the missing figures indicated 1 to 3 on the fixed asset note. All right, so we're going to do the fixed asset note. We have our vehicles, our buildings, and equipment. Let's begin first with the vehicles. Information given says, an old vehicle was sold at carrying value on 30 November 2021. The cost price of this vehicle was 252,000 and its accumulated depreciation on the 1st of March was 172. So 1st of March is the beginning. Vehicles are depreciated at 20% per annum on the carrying value. What must we calculate? The disposal, and we know it's at carrying value. What this simply means is calculate the carrying value of the asset that we have sold. That's what they are saying. Give us the carrying value of the asset that we have sold. All right. So what we understand is that we have a vehicle. We have a vehicle. The first one, let me rather calculate the first one here, the carrying value here. The carrying value here at the beginning, that is the carrying value on the 1st of March. Let me start with that one before I come to this one. Let me start with this one. What is the carrying value at the beginning? Number 1, before I get to 3. Let me start with 1. So it's going to be 2 million. So I take my cost, 2,350,000 minus my accumulated depreciation, which is 840,000. Okay, so I'm starting off with my number 1 before I come to these 3. Let me do them in their order: 1, 2, and 3. Number 1 is the carrying value. To get carrying value, it's cost minus accumulated. Cost is 2,350,000, accumulated is 840. So if I punch that in my calculator, I'm going to have 1,510,000. That becomes my answer to number 1. 1,510,000. Okay, so it is okay. So this one was an easy one to get number 1 here. All right, let's go and do number 2 before we do number 3. Okay, let's go and do number 2. So we did number 1, which was simply us calculating the carrying value there. That one was an easy one. Cost minus accumulated gives you your carrying value. Let's go to number 2. Number 2, then, here's the information. Additional equipment was purchased on the 1st of October. Equipment is depreciated at 10% per annum on cost. So here we want to calculate the depreciation. We understand that when we are calculating depreciation, remember, you calculate depreciation for the son. Sold, old, and new. That is your son. In this case, we don't have the sold. We just have the old and the new. So let's start with the old. The old is given, okay? It says equipment is depreciated at 10% per annum on cost. So my old is given here, and it's 640,000. So come here, it's 640,000. And I'm told that my depreciation is at 10%. I'll come here and I'll say multiply by 10 over 100 times 12 over 12. For the old asset, it will always be 12 over 12. For the old, it will always be 12 over 12. And then if you punch that in your calculator, you will then get 64,000. 64,000. All right. Dear learners, I want you to tell me, why is this 64,000 not the correct amount for depreciation? Why would that 64,000 not be the correct amount for depreciation? Thank you. Because when you look at the top part here, you can see that your asset has a carrying value of 28,000. So if it has a carrying value of 28, it can not therefore have depreciation of 64,000 because its carrying value is 28. But someone say, how are we supposed to know that, Mr. Simbi? Here is a clue. When you get into the exam session and you are being asked to calculate depreciation, whenever you see the cost price method, always open your eyes, because in most cases, the examiner would want to test you on the 1 Rand residual value principle. And the examiner can only do that when they have the cost price method. So when you see the question paper, you see the cost price method, always think, could they be trying to test me on the 1 Rand residual value method? What then do? You calculate your depreciation, you see 64. Then you say, 64, how much is my carrying value? 28. Something is not right. I cannot therefore have depreciation of 64 when the carrying value is 28. So you then say, I abandon the 64. Then you work with the 28,000. Then you say, 28,000. I cannot therefore depreciate the entire 28. Then I know I must remain with 1 Rand. So I'll say the 28, which is the carrying value, minus the 1 Rand, the residual value. It therefore gives me my depreciation, which therefore becomes 27,999. When do I know if I'm being tested on the 1 Rand residual value? The examiner will give you the cost price method, and then you should always check how much is your carrying value. At times the examiner says the asset was old, or the asset is very old, or the asset was bought in 2001. Already they're trying to say, think about the period that this asset has been with us. It's most likely that it has now reached the 1 Rand residual value. So my depreciation therefore here becomes 27,999, but that is the old. Let's see if we have depreciation for the new. For the new one, we are told additional equipment was purchased. Where is that? Oh, there it is, 195,000. So the new one is for 195,000, and the depreciation rate is 10%. How many months? You have to count physically with your fingers. We are counting from the 1st of October. So we're coming from October until the end of the financial year, which is February. And then you will get 5 months, 5 over 12. And then you punch that in your calculator, you get 8,125. That becomes your depreciation for the new. So now what do we have? We have depreciation for the old, and we have depreciation for the new. So my depreciation for the old, remember, there it is, and for the new, then my depreciation therefore becomes 36,124. Very important, dear learners, that whenever you are asked to calculate depreciation, check, am I being tested on the 1 Rand residual value? Especially when you see the cost price method, the fixed installment method. Now we can finally calculate number 3. Remember earlier on we wanted to calculate it before time. Now is the right time to calculate number 3. Number 3. And then the information reads, an old vehicle was sold at carrying value on 30 November. All right. The cost price of this vehicle was 252,000, and its accumulated depreciation on the 1st of March 2021 was 172. Vehicles are depreciated at 20% per annum on the carrying value method. Okay, so remember what we want to get is, we want to get the carrying value of the asset that was sold. We know that its cost was 252. 252 was its cost. And then it's accumulated on the 1st of March, this is the beginning of the financial year, was 172,000. So 252 minus 172, that should give you 80,000. This is the carrying value of the asset at the beginning of the financial year. The carrying value of the asset at the beginning of the financial year. Now, we have used this asset before we have disposed of it. It was used. It was in use. It was in use until, we are told, it was sold on the 30th of November. That means it has lost value in this financial year. What does that mean? We need to calculate depreciation. If we're going to calculate depreciation, therefore, we are now going to say the 80,000 the 80,000, which is the carrying value, times 20 over 100, times how many months? We are now going to count from the 1st of March until the 30th of November. Okay, the 1st of March 2021 until the 30th of November. And if you count those months, you will see that you have 9 over 12 months. That means in this year, this asset has lost 12,000 to depreciation. So you take the carrying value at the beginning, then you subtract the depreciation that it has lost in this year. And then now we have our 80,000. We have our 80,000, as you can see, and then we calculated, we got depreciation of 12,000. Then we come, and then we are now saying on that 80,000, I can then subtract the 12,000 to get the 68,000. The other way was to get the 252, which was the cost. Then you open your bracket, then you say 172, which was the accumulated, plus the depreciation for this year. It would still bring you to the 68,000. It is very important, dear learners, that you continuously practice on these questions. Dear learners, remember to prepare your corporate governance notes, and please ensure that you understand what you are studying. It is very important, dear learners, as we are preparing for the exam that is now before us, that you also visit your auditing notes. You need to know your auditing notes. You need to ensure that you know the different types of audit reports. That is your unqualified, your qualified, as well as your disclaimer, and the effect that they may have on the company as well. Remember to study your committees, your audit committee, your remuneration committees. You need to study all of those things. Dear learners, we have come to the end of today's class, and I know you are ready for the exam because you have practiced and you have put in the hours, and what you deserve is excellence and nothing else. I want to wish you all the best for the exam that is before you, and remember to take a calculator that you are used to, a calculator that you know. One important thing is to arrive at the exam center in time, be there on time. And one more important thing, remember to practice. Your financial indicators must be known. Must be known. It is goodbye. And all I can say now is I wish you the best because I know you're going to give us the best. Until next time, it is goodbye.